Welcome. Thanks for joining this webinar. Let's kick this off. My name is Roberto. I'm with RMI, and on behalf of the RMI organizing team, welcome to this webinar, Empowering Communities with Solar, How to Leverage Inflation Reduction Act Opportunities at Scale. To kick things off, we have a quick Zoom poll for you to get a sense of where you might be in the process of considering applying to any IRA funding opportunities. Here it is on your Zoom interface. Take a second to reply. The responses will be anonymous to other participants, but it'll give us a really good sense of who's in the room and what your plans might be to use IRA funds. Interesting. About half people are exploring. This is just a quick Zoom poll to see who we have in the room. While you will respond, a quick logistical point, you will notice that the Zoom chat has been disabled for this webinar. We do, however, encourage you to interact with RMI staff using the Q&A functionality of your Zoom app or Zoom web app. The Q&A is where you will be able to ask questions of RMI staff and also post your questions for the presenters. Okay, I think we're shutting down the poll and we're going to be looking at the results. Interesting to see that about 40% of you are exploring, but there is about a third of you who is actively researching specific programs, and even an 8% who is already using benefits and funding. This is really interesting. Okay, so welcome everyone again. This is a webinar in which we will take a closer look at two specific funding opportunities, the GGRF and the ITC, and our two presenters will give you some of the most recent information about these programs, who qualifies, and also how to leverage them to empower your communities at home. This webinar is open to all, and there is no prior knowledge required to join. It will be recorded, and the recording will be sent to you to your email address with which you've registered in a couple of business days. So before we go onto the agenda, I also want to acknowledge that the idea for this webinar came from the conversations on this topic at the 2023 Symposium of the Solar Energy Innovation Network, or SINE. It's good to see here today among you like some people who were at the symposium as well as SINE program staff from the US Department of Energy and NREL. So thank you everyone for joining. If we could move on to the next slide, please. This is where we share with you the agenda for this about an hour we have together. We will have two presentations back to back, followed by a single Q&A segment, which will be between 15 and 20 minutes. Our first presenter will be on the Greenhouse Gas Reduction Fund, and it's Alisa Petersen. Alisa is the Federal Policy Manager on RMI's US program team. Alisa works closely with the techno-economic experts across RMI to ensure that federal climate policy is designed using the best available information. And while Alisa oversees all of RMI's federal policy work, her areas of expertise include carbon-free buildings, renewables, and sustainable urbanization. So thank you and welcome, Alisa. Thanks for joining us. Our second presenter will be Jeremy Kalin on the ITC. Jeremy is a clean energy finance attorney and advisor at the firm Avisen Legal in Minneapolis, where he leads the firm's solar practice and also co-directs its Impact Council. Jeremy has a 20-year plus track record in the industry and has facilitated over $900 million in clean energy projects across the nation, focusing on underserved markets. Jeremy is also a former Minnesota representative, has been a liaison to the White House, and has advised several administrations and organizations, including RMI. So thank you for joining us, Jeremy. Before we dive into the content, I would like to request that all of you who are not presenting or speaking, please turn off your videos and mute your microphones if you haven't already. That will allow us to spotlight the person who is speaking. Thank you very much. Okay, so I believe this concludes our introduction to the webinar, and we can welcome Alisa. Thank you for joining us, and over to you.
Thanks, Roberto. I'm Alisa Petersen with RMI, and I'll be talking about the Greenhouse Gas Reduction Fund, but more specifically, the Solar for All program within the Greenhouse Gas Reduction Fund. Let's go to the next slide. So the Greenhouse Gas Reduction Fund got a lot of attention because it's $27 billion. And it's the single largest IRA investment in low-income and disadvantaged communities. This $27 billion is divided into 3 different pots of funding. The National Clean Investment Fund and the Clean Communities Investment Accelerator are essentially intended to leverage private capital to lead to investments in energy and climate projects. But like I said, we'll focus our attention on the Solar for All grant, which is $7 billion that's supposed to support solar in low-income and disadvantaged communities. Kind of double clicking on that program in the next slide. The way that the Solar for All program works is that it's, instead of going to nonprofit financial entities exclusively, like the other 2 pots of funding, it has eligibility for states, municipalities, tribal governments, as well as those nonprofit financial entities. And the funding will flow in a way where where it can support residential rooftops, community solar, associated solar, and enabling upgrades, as well as workforce training. What's interesting about this pot of funding is that there are going to be much more awards granted than the other 2 pots of funding that will have closer to 2 to 5 awards. This one will have up to 60 awards, and they're hoping to have an award per state or territory. And then there's a specific carve out for tribes that they'll give at least 1 to 3 awards to tribes. If you just kind of take that $7 billion and divide it by 60, that would result in an average grant size of $120 million, which I think is a good ballpark estimate to think through, like, with that size of program, what could be able to accomplish. But this is not a formula funded program, which means that there isn't an amount set aside for each geography. And they're going to decide how much funding goes to each geography based on various factors, including solar deployment potential, how much the project will reduce greenhouse gas reduction, how much it will actually serve low-income households and reduce their energy burden, and various other factors, including, and very importantly, kind of the geographic reach. So if a state is doing a Solar for All program, they can likely serve their whole state. Whereas if a state's not planning to put in an application for Solar All and maybe only one city is going to put together an application, there is kind of a concern there that they might get a grant in that state, so checking the box, but it would be a very small grant because it would just be for one city. So one thing to really be aware of for Solar for All is that if your state is not putting in an application, being able to kind of coordinate as municipal governments, tribal governments, and nonprofit financial entities in order to kind of serve your full state will be important in order to get a large grant. Going to the next slide, the way that this funding is going to roll out is that the EPA is going to release a notice of funding opportunity, likely either end of June or early July, so coming up very soon. And that notice of funding opportunity will just be open to states and territories first. They'll have kind of a short window to essentially say whether or not they're planning to apply for this funding. And then after that, those applications will be public. And so at that point, tribal governments, municipalities, nonprofits can look at whether their state is planning to apply. And if they're not applying, try to coordinate kind of like a coalition application to serve their full state. EPA doesn't explicitly say that if a state applies and a coalition of cities applies, that the state will definitely get the award, but I think they strongly apply it because in their framework, they say they are going to prioritize states that prioritize geographic area, the ability to serve geographic areas, which oftentimes states might be more able to do than a coalition of cities. So if a state's applying, coalition of cities can still apply, but it's kind of an uphill battle. So it might be more relevant in areas where we know that the state is not planning to apply. The other thing to be aware of for the Greenhouse Gas Reduction Fund is on the next slide, which is, so this Solar for All program originally wasn't actually called Solar for All. In the legislative text, it was called the Zero Emissions Technologies Program. And in that, it said it was eligible for any greenhouse gas reduction technology. And so the original intent seemed to be opened up to energy efficiency and electrification. And kind of as EPA has been updating their framework, it's narrowed its focus a little bit more to just largely focus on solar. There is like a small window where potentially this program could still serve energy efficiency and electrification projects, which is that it says it's eligible for rooftop solar, community solar, associated storage, and other enabling upgrades. The way that they mention other enabling upgrades in the framework is they mention like electric panel upgrades, roof repairs, but they also leave it somewhat open, saying EPA expects each applicant to define enabling upgrades in their application. So assuming the notice of funding opportunity doesn't get more explicit, I think there is a really unique opportunity to think through how Solar for All can be a more comprehensive program to pair solar with energy efficiency, with electrification, because as you know, while solar is great, there are some places that maybe they can't access a solar only program due to limited space, like dense urban areas, or due to regulatory barriers. And then similarly, oftentimes if you do holistic upgrades, it is more cost effective. And so this is one area that's still in flux in EPA that we are hoping any applicant will be able to kind of hopefully get energy efficiency and electrification back into the program. As the programs are being designed, next slide, please. The first thing that people will want to do is look to see if their state has existing solarized and community solar programs, because that's kind of the starting point. If you have an existing program that can easily expand, it's a lot easier to just do that than just start something from scratch. But we also know that a lot of the existing programs might not serve the full community. They might not serve the low income and disadvantaged communities in the way that that is required via legislative text. And so really familiarizing yourself with the existing programs will be an important first step. I mentioned the ability to serve low income and disadvantaged communities, and I think that's important to be aware of. So 100% of this funding needs to go to enabling low income or disadvantaged communities access to solar, but only 40% of the funding, according to Justice 40 principles, need to actually benefit low income and disadvantaged communities. So those are slightly different numbers. Obviously, we want that benefit to be as close to 100%. And I think that's like another evaluation criteria that EPA is looking at, like how well are you serving these communities and benefiting them. And so being able to really dive deeply into the programs that exist and answer those questions is step number one. Going to the next slide, step two is Step two is understanding the regulatory barriers. So if we're doing community solar, the first thing to look for is, does my state have enabling legislation for community solar? 22 states have enabling legislation, but 39 states actually have community solar. And if you look at the 4 states with the most community solar, Florida is actually one of them. And if you look closely, you'll notice that they don't actually have any enabling legislation. And so having enabling legislation is like ideal and I think what you'd ideally want, but you can still do community solar even without that. You just need to engage your utility much more heavily. And so understanding, one, if you have enabling legislation, and two, like whether your utility is open to supporting community solar programs is really important in designing the Solar for All program to decide whether it's a community solar program or potentially just residential rooftop. If you're looking at residential rooftop, potentially a solarized program, one of the most important regulatory things to look into is net metering. You'll see that this map is much more, nice looking in terms of most states do have some type of net metering legislation, but not all net metering is created equal. So, some net meterings allow for different rates, different rollover policies, whether there's a demand charge on the bill or not. And so really understanding kind of granularly what your net metering policy is within your state will be important. And potentially, I think for both of these, this new pot of funding is an opportunity to engage with your state legislatures and ask for more beneficial policies that will support solar for all. And then finally, kind of the third thing to keep in mind on the next slide is how this greenhouse gas reduction fund Solar for All program will stack along with other incentives. So we know that there are a bunch of new federal incentives. Obviously, there's state, local, and utility incentives. We'll go much more into the weeds on the ITC shortly. But understanding, like for a typical project, okay, how much are people actually paying? How much are people actually paying upfront for this project? Are they able to access direct pay? Will this be in an energy community and therefore they'll get a 10% adder? Will we be able to meet the domestic content? All of that will help inform whether like the size of the rebate or the loan for the greenhouse gas reduction fund, or whether we need a subsidy or a loan or something else. And then if we are thinking about the Solar for All program as almost like a Solar for All plus to include energy efficiency and electrification, you'd also need to factor in the Homes and the Hero program, which are new federal programs that support beneficial electrification and efficiency, as well as other state, local, and utility incentives. So to wrap up on the last slide, I just wanted to end with a timeline. So we are at a very interesting moment, which is that the notice of funding opportunity is pretty much going to open up any day now for the Greenhouse Gas Reduction Fund. And once that opens up, we're entering about a 2 to 3 month sprint where the application window will be open. And so if you are planning to submit an application, doing kind of all this research that I mentioned above, needs to happen quickly. And if you are planning, if you're wanting to, if you want to make sure that a program is designed in a way that you can benefit from it as a, whether it's community solar or residential solar owner, figuring out who is actually putting in that application and reaching out to them and making sure, your asks are included in the design is important over the next 2 to 3 months. It'll take EPA a little bit of time to evaluate all the applications, and so money won't actually start to flow until 2024. So thinking through kind of when will this Greenhouse Gas Reduction Fund Solar for All program funding be available, not for the next 6 months, but soon enough that if you have a solar business model, making sure that this is incorporated in that will be really important. So that's all for Solar for All. I'll pass it back to you, Roberto. Thank you.
Thank you so much. Thank you, Alisa. If anyone has any questions on Alisa's presentation or the GGRF more broadly, please do post them in the Zoom Q&A so that we can come back to them and address them during our Q&A segment. That's all for me. The floor is yours, Jeremy. Thank you.
Excellent. Thanks, Roberto. Can you just confirm quickly that you can see my slides? Excellent. Well, I'm Jeremy Kalin. It's a real pleasure to be with you and to follow on the heels of Alisa's exciting information. It's also really exciting to see so many familiar names, both from the Sign Symposium a couple months ago in Denver, and folks have been working with for a very long time to advance solar in a more equitable way and expand access to solar financing.
Jeremy, excuse
yes.
me. We're seeing your presenter view right now.
You're seeing presenter view. All right.
Yes.
So
swap displays in the upper left.
There we go. How about now?
There, perfect. Thank you.
Awesome. I told you offline that I'm a Luddite, and there you go. So thanks for catching that. So a quick introduction on my end. So I'm Jeremy Kalin. I'm a solar finance lawyer, as you heard. I work all over the country. I'm admitted to practice formally in Minnesota and Washington, D.C. in the District of Columbia, but work with clients all over the country. The name of our law firm, Avisen, is Old French and Middle English for advisor. And that's a lot of the work that I enjoy the most about this gig, is really helping structure and understand how to maximize the opportunities, both in terms of public programs and public policy, and especially in terms of mobilizing capital, both public and private, to make clean energy and climate progress more accessible to all. I want to put a little bit of the investment tax credit itself for solar in context, and kind of make sure that you understand, as folks are talking about, as you hear all these acronyms and other pieces of the Inflation Reduction Act. The IIJA is also known as the Bipartisan Infrastructure Bill, and the CHIPS Act, which really advanced competitive manufacturing in the United States. All three bills, more than $1 trillion of investment from Congress. There's an asterisk on the Inflation Reduction Act that I'm going to hone in on here in a second, and that's where we're going to spend our time in looking at the Inflation Reduction Act and the McKinsey chart of where funds went to is actually outdated at this point, and I'll explain why in a second. But I love this chart because 96% of the authorized expenditures and of the appropriation went to agriculture, energy, and the EPA, to the Department of Health and Human Services, and the vast majority, you see there, $345 billion, was committed to the Department of Treasury. Now that number, because so much of what we're talking about are tax credits, they actually don't have a fixed appropriation. So the more demand that we create for the tax credits and the more opportunity, the higher that number goes. I'm a progressive Democrat, as you may have figured out, represented in the legislature, a very conservative, I am also an odd duck fiscal conservative who is quite frugal about my own expenditures and public expenditures. But oddly, as somebody who believes in progressive taxation, the best way for us to meet the climate challenge and meet the equity challenge in front of us is to get people to reduce their taxes and maximize the federal tax credit. So in essence, everything we're about to talk about is our opportunity to continue to expand and scale the impact of the Inflation Reduction Act. So as I pointed out, the Inflation Reduction Act has a significant amount of direct funding, and on the clean energy side, the consumer, so the residential tax credits were initially priced at $43 billion. They're actually likely much higher than that in the end. And the including nonprofits, the commercial credits, which is what we're going to talk about the most here, even when we're talking about low income and low and moderate income residential projects, we're in that commercial bucket of $173 billion, almost all tax credits. One of the biggest achievements of the Inflation Reduction Act was both extending many energy tax credits, expanding some, and creating entirely new ones. And so here's just a general list, not a generic list, a general list. I'm going to focus on the Section 48 Energy Investment Tax Credit. This is the ITC. You no doubt have heard things about hydrogen, about the 30C tax credit, which is the electric vehicle charging infrastructure credit. Things about the production tax credit for wind and solar is eligible for the production tax credit. But really, in my experience and out on the street, I think the investment tax credit is by far the biggest lever of the tax incentives that we should all be focusing on for equitable solar development. What now is in the bucket of energy property that's eligible for that Section 48 Energy Investment Tax Credit? Well, solar continues to be, along with true geothermal, as opposed to ground source heat, as you'll see there. Show me folks that are doing true geothermal and you'll knock my socks off. But the broad term of geothermal is eligible, including as well as fuel cells. I'm really excited about the energy storage component. Now on its own is an energy technology eligible for the investment tax credit. It doesn't have to be paired with solar as it used to be. So we're going to focus on the solar power piece of this. Solar thermal is in the same definition, but solar PV that's focused on generating electricity. You probably have heard this term, or you may have heard this term before the Inflation Reduction Act, of the solar coaster. The green is the graph of the wind production tax credit, and the yellow is the graph of the solar PV investment tax credit. That you can see this up and down and up and down, hurry up and wait, stall projects, et cetera, a lot of uncertainty. And before the Inflation Reduction Act, we were on track to be on this step down from 30% ITC value to 26 to 22, and then we would be at 10%, if I recall correctly, now. Many of us who don't love using tax credits for public policy were excited about the other pieces that were on the table during the Inflation Reduction Act early days, known as Build Back Better. But one of the best things that the Inflation Reduction Act did was to extend, I'll go one slide further, I think here, at 30% for the next decade, the investment tax credit for solar. Now, I'm going to put an asterisk here because you see there's two tiers. And the standard tax credit for solar is actually 6%. There you see at the bottom. For larger projects at 1 megawatt and above, as measured by their alternating current output capacity. I said output, I meant capacity. Please, all you technicians out there, don't rail me for getting something wrong on that front. But if you comply with the prevailing wage requirements, prevailing wage and apprenticeship requirements, then the base credit is 30%. Much of my work actually is focused on clients that are developing smaller projects, so smaller than 1 megawatt AC each. And so the default or base credit level for those projects is 30%. Like I said, I'm going to focus on, I think for the equity pieces, and our focus, I'm going to focus on these smaller than 1 megawatt AC projects. Because there are some of the information I'm going to share in a moment related to adders that you've heard of and heard about. They are not applicable to all size projects. But I think for folks on this call, on this webinar, and from the signed participants, I think familiarity with these small projects is really most useful. So I want to make sure that we're level set on both the basics of the investment tax credit and then some of the quirks and tweaks that you need to be aware of. Particularly, remind me if I don't already raise this, the Solar for All grants as federal funds and any other grants are going to be really important to consider in their interaction with tax credits and tax incentives under the Inflation Reduction Act. and the rules being developed by Treasury and the IRS. So at that 30% base credit, I'm going to just use $1 million project cost. So maybe a 350 or 400 kilowatt project. But let's say that's $1 million, all of the hard costs. The owner of that solar system can claim a federal tax credit that's equal to 30% of the project cost. So we're talking about $1 million project and a $300,000 credit. I want to walk through first the for-profit solar owners, both how it's been and what's been improved by the Inflation Reduction Act. And then I'm going to shift to nonprofit solar owners, or tax-exempt owners of the solar systems. So there are 3 ways to turn that $300,000 credit into actual cash value. So the first is what a colleague of mine calls self-serving solar, meaning solar that's owned by a for-profit entity on their own building. The building owners, because the solar is part of their capital, their total building, it's a fixture on their building, those building owners can claim the federal tax credit equal to 30% of the project cost. That credit, though, is non-refundable. So a building owner with solar on their roof has to then either have a $300,000 federal tax bill where they can monetize the credit and the depreciation deduction benefit that can be as valuable as the creditor or even more so, or they need to take advantage of spreading out that credit over time. For most of you on this webinar, this is pretty basic, straightforward information, but it's really important to understand that for a for-profit solar owner, the credit is still non-refundable. If the business owner, the building owner, does not have that big, significant, what we call tax appetite or federal tax bill, then a third party separate from the building owner can lease the roof and own the system and claim the tax credit and can claim the depreciation deduction. Now, the challenge in these circumstances is that Congress did not change what has been the bane of my existence, which is subjecting to the investment tax credit to something known as the passive loss limitation or the passive income limitation. So those of us who pay a federal tax bill but don't have passive income, we cannot just offset our W-2 income, you know, the ordinary income you get on your paycheck, or even standard capital gains. I can't take that $300,000 credit and, you know, spread it out over 10 years and offset a $30,000 federal tax bill, let's say. I can't do that because I don't qualify. I don't have passive income. And I'm also not one of the 2 categories that are exempt from passive income, which are C corporations or real estate professionals that have a big tax bill. So think large commercial property owners, you know, the Warren Buffetts of the world or major C corporations. So that's like why you see Apple and Alphabet, and Google, and others like those that are investing in wind and solar projects for the tax benefits to bring their corporation's tax bill down to 0. The third way that a for-profit solar owner can monetize the tax credit now is to sell the credit. This is a new Inflation Reduction Act provision called Section 6418, known as transferability. For years, we've said that the credit is non-refundable and non-transferable. It is now transferable once, meaning the buyer of the credit cannot then go and resell it. So it's an anti-fraud, anti-securitization, anti-housing collapse, mortgage crisis scenario, which I support a great deal in terms of the public policy. Originally, we had hoped that this was going to open up the potential for new buyers of the credit. The answer is it's not. The new credit buyer is subject to the same restrictions as if they're the original credit claimant of the solar system itself. So if you've heard about the 6418, the ITC sale, as being something that can totally open up the market for solar, you're halfway right, or a quarter right, in terms of what you've heard. It is not the panacea that I'd hoped that it would be. Now let's talk about nonprofits. In the past, and going forward, but in the past, the only way to monetize the tax credit has been for a nonprofit owner or a homeowner that doesn't have the tax bill to recognize to turn the credit into money. A for-profit solar owner could lease the roof, own the solar system, be responsible for building all of the solar costs, et cetera, and then take advantage of the credit, just like in the for-profit building owner. Nothing has changed on this front. It's still a viable option. It still does create challenges of finding those tax credit investors who are interested in investing in equity and solar in underserved communities as much as they might be interested in a utility scale, $500 million project. It's been a big challenge. It's what I've been doing the last 15 years as a consultant and now as a lawyer, trying to attract and de-risk this investment for new investors. What you have no doubt heard about and talked about and investigated is the option under the Inflation Reduction Act, the new section 6417 of the code, of the tax code, that allows nonprofit owners of solar, not the building, but the solar installation itself. So the nonprofit could own the building and the solar. The nonprofit could be leasing other people's roofs, whether it's affordable housing, residential buildings, or it's a nonprofit owning on a for-profit building. As long as the nonprofit owns the solar installation, you get through the first step of claiming elective payment, which means you probably heard it also described as direct pay. I'll talk about this in more detail in a moment, but it's important to note that this includes states, cities, other local governments. The IRS guidance formally issued today, but posted last week, includes instrumentalities of the state. So I saw a question about a nonprofit water resource that might be interested in the grant side of things. We'd have to go through the analysis to understand whether you might be able to take advantage of this direct pay and actually get a direct refund and payment from the IRS. So again, we'll talk about the mechanics, I think, in a few minutes of the elective payment. But before we get there, I want to talk about the other components, these adders to the investment tax credit for solar and for these small solar projects. Again, trying to hone in on as few variables as possible. So the base credit for these smaller projects under 1 megawatt AC nameplate capacity is 30% of the project costs. You can determine the basis through other means, but the easiest way is what's known as cost basis. So again, that $1 million project starts with a $300,000 potential credit. One of the adders is the Energy Communities bonus. And to access that bonus, more than half of the capacity of your solar project needs to be located in a brownfield, defined in a number of ways, including if you have done a phase 1 environmental assessment and you found present some hazardous materials and some remediation is required. That's most likely, my guess, the first step that sign participants and others on this call, on this webinar, might be most able to access that 10% bonus. There's also the statistical area potential. This is 1, 2, or 3. You don't have to satisfy all 3 in order to get the 10% bonus. But this is generally countywide census information. If you have basically I did the math last night, 1 out of every 600, if I remember right, employees are employed in the production of fossil fuels or mining of coal, et cetera, or 25% of that county's tax revenue comes from fossil fuel activities. Or if you're an area that's had a coal mine closed in 2000 or later, or a coal power plant that's been retired since 2010. Some people refer to this as the Senator Manchin provision. But if you really think about this, is the repowering economies provision as much as anything. No doubt you've heard about the domestic content bonus, which could, on its own bring us up to 40% for the investment tax credit for a project. So that $1 million project would suddenly be eligible for a $400,000 credit. This one is going to be quite challenging for now to meet under the proposed rules and the guidance received from Treasury and the IRS. The easier part is that all structural steel and iron must be US made or comply with the Buy America provision in the Transportation Acts. And the second is that 40% of all manufactured products and components either be 100% US made or be deemed to be US made. It's a quite complicated formula that includes everything like sourcing the individual cost of adhesives and of gaskets for projects in 2023 and 2024. The percentage actually increases even to a tougher threshold in 2025 projects. And in the words of Treasury, sub-cabinet officials driving the investment tax credit implementation or the IRA implementation, this is meant to be a bonus. There are some projects I think they're going to meet this threshold. Know that as a developer or as a project owner, you're going to have to certify that under the penalty of perjury, that your components meet the domestic content bonus requirements, as I've laid out here. However, it's really going to be the manufacturers and the suppliers who are going to be the ones certifying that they have met, because they're not going to want to go through each project component and tell the public the individual costs and the individual project or product margins for every single component behind it. So I don't want to get lost in the details of domestic content bonus, other than to say just focus on the word bonus. And my advice is to focus instead on the opportunity of the low-income bonus credits. There's 2 different groups. Categories 1 and 2 are a 10% bonus. And that's for projects located in a specific defined low-income community under Section 45D of the tax credit. So it's the distressed communities that overlaps with the new markets tax credit definition. And the second category is located on Indian lands. And all of these low-income bonus credits are subject to a national cap in 2023 and 2024 of 1.8 gigawatts across the country. I sit on the Novogradac Renewable Energy Working Group, tax credit working group, advising Treasury and the IRS on implementation. And to Treasury's credit, the first outline of their guidance was challenging and likely not going to work. And they really heard our critiques and have proposed a process I'll lay out in a second that's going to start with these 20% low-income bonus credit categories. The first is solar on federally supported low-income residential buildings, multifamily buildings, of which 200 megawatts is reserved. And category 4 is the qualified low-income economic benefit, where projects at least 50% of the economic benefit, which can be energy savings or can be other means as laid out in the most recent rules, 700 megawatts are reserved first for that category 4. First, I want to urge some caution. You must have received from the IRS an allocation letter before you activate your solar system and place it in service. Now you can complete the projects and get them ready to be placed in service, like get permission to operate and utility approval. But until you have an allocation letter, you should not flip the switch and turn on your systems. DOE is telling, or IRS is telling us that DOE, as we recommended, is going to be running the application process and the evaluations, and that window should open in July or August of this summer. At some point, there will be a point when they stop reviewing applications for categories 3 and 4 first, the 20% categories. And then if there are more than the 700 megawatts, for instance, in category 4, DOE will then, and Treasury will together review whether additional selection criteria are met, including nonprofit ownership of the systems, qualified renewable energy companies that are locally based with, kind of small contractors with 10 employees or fewer and a record of installing projects in the past, cooperatives, et cetera. So, the specific details need to be understood to position yourself most competitively, but pretty pleased that Treasury's responded pretty well. Want to quickly cover elected payment and then take as many questions as we can before the top of the hour or bottom of the hour, and then I can stay on for a little bit longer. But the elected payment, I just want to make sure you folks understand, you have to own the solar system for at least 5 years. You're still subject to the recapture rules. As I shared, the tax exempt entities include nonprofits, include rural cooperatives, which I'm excited about. The way to access the credit is you will have to pre-register your intention of electing the 6417 payment on the electronic portal. You cannot, nonprofits actually won't be able to take advantage of 6418 transfer and sale of the credit. So this is what our opportunity is. The depreciation benefit doesn't, of course, accrue because you can't deduct and reduce your tax bill if you're a nonprofit or a state or local government. And the pre-registration steps are now laid out by the IRS. The portal should open very soon. I haven't checked today. Today, this guidance was formally posted, and so I got been prepping this webinar, so I have to check on that. One last piece that's really important to know: the special rules for grants. First of all federal funds, so Solar for All funds included, community development block grants, et cetera, reduce the basis for calculating the credit. So in this case, a $1 million project with the $200,000 of federal funds, the beginning basis for calculating the credit would be $800,000. So $240,000, not a $300,000 credit. That's just general tax law, no double dipping. Tax exempt income grants. This is actually already bubbled up for one client, and had a conversation this morning about another project where this is going to impact. If the total of the grant, so in this case, let's assume a $750,000 credit, and the total $750,000 grant and the credit exceed the total cost of the project, then the credit will be reduced so that the sum is only 100%. So in this case, we'd reduce the credit by $50,000. Finally, a quick word about the process. So as you heard, I've been involved in politics for quite a while, was in the state legislature, got to do stuff that was really fun and logical. A lot of politics is, bringing folks to the table, hearing from stakeholders of all sorts, building good policy, cajoling colleagues and other lawmakers, and trying to get things done. Sometimes you're in the subordinate position and having to beg committee chairs or speakers or Senators Joe Manchin and Kyrsten Sinema to get to yes. And what happened with the Inflation Reduction Act, it was exactly that Sinema and Manchin senators needed to get to yes in order to get to the votes required to pass the Inflation Reduction Act. Once you have the votes, you vote. And so Treasury and the IRA and DOE and others did not have time to be consulted and change language very much around the final provisions that get you to the votes you need. So holding Bernie Sanders and Joe Manchin in the same coalition, getting them to yes was really important. And thus, that's why we are having to work with Treasury and the IRS and DOE and all sorts of others on the implementation rules, is because that's the necessary part of politics. Hopefully at some point you get to this celebration and actually, are where we are. And like I said, Treasury's been really, really helpful in helping us achieve the result of implementation and workability that we're all after. So with that, I think I hand it back to Roberto.
Excellent. Thank you, Jeremy. And you can stay on camera, actually, so we can get to the Q&A. Before we do that, however, just a couple of service announcements. Firstly, I just want to share our speakers or presenters' contact details, and I hope that's okay with both of you. Your email addresses, if we could please have that slide with the two emails. You're welcome to contact Alisa and Jeremy with any further questions you may have on either GGRF or ITC. Also, we have a quick survey that I'm going to share with you in the Zoom chat. Here it is. Please fill it out if you have a few minutes. This will really help both RMI and Avisen Legal understand what your needs might be around orienting yourselves or applying to these funding programs. So please take a few minutes, and it will really inform the way we can support you with future webinars or other ways. And here is the slide with the contact details of our presenters. Thank you very much. Okay, so let's now dive into Q&A. I think we have a couple of questions for Jeremy, and one of them is this one here. Maybe I'll just post it in the Zoom chat for everyone to read. Jeremy, the question is, can the storage tax credit be used to fund tech development? And can the same apply for solar PV?
So the investment tax credit, you could use for projects that get placed in commercial service. You could use the storage as Section 48 property and then put that those systems into service and take the tax credit that way. For pre-commercialized technology development, the federal research and development tax credit, the R&D tax credit, is probably a much stronger incentive. If you get to manufacturing side, then looking at things like the 45X manufacturing credit could be a better suit for you. The investment tax credit is really about project finance and projects being placed in service at scale.
Excellent. Thank you, Jeremy. Another question, I think still for you, is, are landfill sites considered brownfields?
I'd be shocked if the answer is no, because you would find on a landfill site that the phase 1 environmental assessment would find materials that need to be mitigated. I'm happy to follow up with that answer, but I think it's safe to start from a presumption that likely yes, that landfills should meet the energy community's definition of brownfields.
Thank you. And another question for you, Jeremy, is, are you able to stack the low-income benefit with 50% low-income benefit bonus?
So you can't stack the one of the 4 categories of the low-income bonus. There's the categories 1 and 2, which are the Indian lands and low-income community census tracts. You only get one of those 4. And so it's one of the 2 at 10%, or if you're meeting the economic benefits test of category 4, that's the 20%. You have to choose one or the other. So you can't stack those, but you can stack them with energy communities and domestic content bonus. You might have, folks on this webinar might have been part of the early days of excitement when as much as 70% of projects could be funded from investment tax credit, well, it's true. But will be a lot of work in order for those very special projects to meet enough tests to get to 70%.
Thank you, Jeremy. I think we have two questions for Alisa, actually. I don't know if Alisa, if you're able to come on video for these, but one is, does Puerto Rico count as a state for Solar for All?
Yeah, and apologies about that. So states and territories, there will be an award for every state and territory. So Puerto Rico will receive an award.
Thank you. And another question for you, Alisa, here it is in the Zoom chat. Is the assumption correct that a state application can include multiple solar arrays?
Yeah, so the application is actually for a program. So in general, like that might mean multiple community solar projects, or a bunch of residential rooftop solar projects.
Excellent, thank you.
I want to add just one, I mentioned this as well, Roberto, in the ITC pieces, but one of the considerations that folks working towards Solar for All program design and applications need to be really cautious of is not to rely on the elective payment or the 6417 direct pay options or any other tax credit where you might be at risk of saying that you're going to re-grant those Solar for All programmatic dollars to pay for the construction of projects. A loan is different. Prepayment of a solar lease or power purchase agreement like DC's Solar for All program is different than just a grant to pay for construction, but you got to be really thoughtful about those design elements so that we don't end up tripping ourselves down the road.
Excellent. Thank you. I don't think there's any more questions on GGRF, but I see one more question for you, Jeremy. And here it is in the Zoom chat. It's about a landlord with a solar and battery storage system on a rental property, whether or not they qualify for the tax credit in that case.
This came up recently, and I'm trying to remember that I would have that person reach out to me. And this is me buying time to go back and look at my notes from when I recall that the answer is that you can actually claim that credit because there's a complicated waterfall of exemptions in the tax code, but residential property ends up not getting caught in those exemptions, if I recall correctly. So my first instinct is to say yes, and I'd like to have time to go back and reconfirm. And I would say that the advice that the question asker, whatever the better term would be, the person who asked the question, the first response they got is a reasonable response from somebody giving that guidance. But I do recall being pleasantly surprised when I got 3 or 4 references deep in the code that indeed, if I recall correctly, it is actually an eligible property for the investment tax credit.
Excellent, thank you so much. So we are officially at the end of our webinar. Jeremy, is it okay if we continue the Q&A with you?
Absolutely.
So thank you to everyone who joined us. You're welcome to stay on with more Q&A with Jeremy on ITC. If you're leaving us, thanks for joining us and see you next time. Let's keep going with the next question that I see here. I am posting them in the Zoom chat so everyone can see them. Jeremy, it's what possibilities or models do you see for monetizing the tax credit for community solar projects?
Yeah, I have several clients that are community solar developers and owners. Like I said, I think we're still going to see the third-party tax equity partnership model where a tax investor joins the entity, the LLC that's created that owns the solar project for at least 6 years, if not a much longer term. And I think both because of the appetite for investing in solar broadly and the fact that 30% and maybe other bonuses get stacked up if you for instance, able to get to 50%, or domestic content get to 60%, it's going to be a very attractive project for-profit tax credit investors. The other thing that we're seeing more and more from is the interest in the 6418 transferability of the investment tax credit. So right now, the tax equity partner has to invest in the LLC before the system gets activated, before it's placed in service, just like that allocation letter for the low-income bonus. The transferability provision means you have until the fall of the following year. You could turn on the system today, it's June, and I could be shopping around for 15 months to find somebody to purchase the investment tax credit that's associated with that property. And so I think we'll still see both the for-profit owners through tax equity partners and through the ITC transfer. The other thing that I think we need to look at more carefully as a community, and I as a tax credit lawyer, as a solar lawyer, is at what point might it go too far to replace for-profit owners with nonprofit owners? Because if it's a smaller system that's eligible for elective pay, and the 30% plus, the economics might work out beautifully. I can just describe not a solar project, but our our boiler at our synagogue, where I'm the safety and security director, volunteer gig. We need to upgrade our boiler, and we don't want to replace it with a gas boiler. So a ground source heat pump, hot water system may be what we end up choosing. And comparing the cost of a boiler replacement with slightly more expensive and maybe some ducting and other, we don't actually know which technology we'll end up choosing. But being able to take 30% off of that through the 6417 elective payment of the ITC, well, that's a phenomenally better deal, right? We do a lot of biogas projects where we're capturing methane and preventing that from getting released into the atmosphere. And the engineers are able to go to their city councils or their elected boards and say, gosh, we just cut the cost of our project 30%, which you never get to do, right? So I think we should be really thinking about that for community solar, how often we can get nonprofits to be the owner operators and get the elective payment of the credit.
Thank you, Jeremy. One more question for you is, can the credit be gifted to a local government or a nonprofit, or does it have to be sold? This is for it's in the Zoom chat.
So no, the credit cannot be gifted. The value of the credit could be in some circumstance, but it's going to be far more efficient for the nonprofit or the local government to own the systems. The 6418 rules that were also released, draft version last week and officially published today, so the transferability rules are quite clear around the intent of Congress was this box. We're going to stay in that box. There's lots of latitude around business models and what you choose to do or don't do with the cash and the other income or the offset avoided taxes, et cetera. But the sale by statute has to be for cash, and the transferee, the buyer, can't then re-gift or retransfer that credit in any way. It's impossible to transfer it again. There are other special rules about how we might structure the ITC transfer itself, but getting a second transfer is not allowable.
Thank you. Next question is about whether for-profit co-ops can get the direct pay.
Email me and I'll walk through the specific answer. The short of it is no. You have to be exempt from taxation. And so if you are being taxed as an LLC, as many co-ops are, and not exempt from taxation, then you likely don't meet the applicable entity list in 6417A1. or A1A, I can't remember but in that list that's in the code. So there are some, I will say, I have a client that is a cooperative that has been in discussions with Treasury, and Treasury is still accepting comments on 6417. Actually, they'll have a public hearing in August. The sooner you can put comments in, the better. But I would be pretty vociferous about why cooperatives might fit within the list, even if they're not subchapter K exempt cooperatives. But I'm not a cooperative expert. My colleague Kim Lowe is an amazing cooperative expert, and we have started spending more and more time digging into this very question.
Thank you, Jeremy. Also on direct payment, there's a questions actually to clarify the process for nonprofits in a bit more detail, if you can.
Yeah, and I see that question in Q&A as well, that I think is also about the timing specific provision, right, Roberto? That so it's unclear to me about yet, with the guidance officially only being released today, whether if you do need to file a 990 every year. So if you're not a church, or church is the term we use for synagogues, mosques, churches, houses of worship. That's the tax code term. So churches or states and local governments that are exempt from filing 990s, or if for some reason, I suppose you're filing a 990 easy if you're a C3 that's got not enough revenue to trip for a full 990. In those cases, it suggests, let's say the city of Minneapolis were to own systems and, or a church was to own the system. It appears from the guidance that what I had hoped and what other tax attorneys and I had been discussing is that the nonprofit could file for the credit and thus the elective payment the day after the system is activated. So you'd file the 990T for 2023 if it's a 2023 project the next day, along with 3468 and 3800, the two tax forms. It's unclear whether the IRS would then process that return. I also need to go back through and look at the specific mechanics of, because you need to actually file the tax credit on your original return. So I believe if you're a larger nonprofit that's currently having to file your 990 every year, your nonprofit organization, let's say under 501c3 or C4, that you would need to wait and get a bridge loan to cover that costs, and then file your 990 on your regular tempo in the early spring, hopefully, if you have your stuff together, and then would get the check back as soon as possible. So I was hoping that it was going to be more proactive than that, but it doesn't look like you can. The other thing I'll say is the 6417 doesn't allow for using lookbacks, so it, which makes sense, and doesn't allow for carry forwards. Not why you would carry this forward, I don't know, but if you're a sophisticated nonprofit that has business income that's taxable, you will need to offset that taxable income by the credit payment. So your actual check will be smaller, but that doesn't apply to most nonprofits, I think, that I've been introduced through Sign and others.
Thank you. I have a question here that is also related to the donation concern. Is there a way for a nonprofit to make use of either transferability or elective payment for a donation?
I guess I'd have to know the specific facts. My inclination is that it's the line between being a little bit creative and thoughtful and being too cute by half is going to be a tricky one to navigate. My advice is going to be pretty conservative on this front. The transferability, I can tell you, well, a nonprofit that owns the solar project cannot access the ITC transferability. right? So you can't sell the tax credit if you're a nonprofit. How you would turn that into a donation as a direct payment is unclear to me as well. So I'm not quite, I'd have to know the circumstances to be able to address the question more directly.
Thank you. And here's a final set of questions that is about, it's in the Zoom chat, it's about ownership structures and whether a family trust counts as an individual for the low-income communities bonus credit program. Additional selection criteria.
I'd have to consult one of my colleagues to get you that answer. My trusts are typically not, even family trusts are typically not individuals, as I remember, but I'd have to talk to the same colleague, Kim Lowe, who's an entity expert, but not an energy expert yet. I'm trying to get her up to speed as quickly as I can, but I don't know that would be, in looking at what you put in the chat, I don't know that it would be necessarily determinative either. I think that you'd be still okay for the qualified renewable energy company consideration.
Excellent. This is all the questions I see, and thank you so much, Jeremy, and thank you also for being available to be contacted via email. We appreciate that. I just want to, before we wrap up, remind everyone that we will be following up with a recording of this webinar, as well as additional materials, potentially speakers' presentations as well, or at least one of them. So thank you, everyone, and please remember to fill out the survey if you can. And thanks again to our speakers, Alisa and Jeremy. Thank you.